Last year's stock market was nothing short of chaotic, and there's reason to believe this year could be just as bad. In this video, I'll walk you through the 9 market-moving events that could shake stocks in 2021, scenarios no one is expecting. We'll look at what might happen, how likely it is, and how to invest if it does. We're talking stock market investing for 2021 today on Let's Talk Money. Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel. I want to send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, this is one of my favorite videos to do each year. It's a look at different scenarios and how to invest in stocks for each one. It's these changes in the market consensus, that direction in the economy and in stocks, that's going to make you higher returns in your portfolio. We'll start with a quick look at the 2021 stock market. What assumptions are investors already making about stocks? That's going to give us a great baseline to see how these 9 scenarios would change things and how you should be investing ahead of time. I'll then reveal each scenario, how likely it is to change the market, and how to prepare. Now I'm going to be ordering these from least to most likely, so make sure you stick around to the end for those events that will definitely happen and change the direction in stocks. Before we get started though, I want to throw this out to the community. Which market moving events are you watching for 2021 and which do you think are the most likely to happen? I'm covering the top 9 I'm watching here, but let's round it out to 10 with your top pick. So scroll down and let us know in the comments and we'll see how everyone did at the end of the year. If you haven't signed up to the Daily Bowtie, look for that link in the video description below. You'll get daily market updates, the most important news, stock market trends, and what to watch, all delivered straight to your inbox. This is something completely new for this year, something I've been wanting to do for you out there in the community for a while, and it's totally free, so look for that link to sign up. Now, as we're talking about each of these scenarios, remember the market is said to be forward pricing. That means it's taking the most likely picture for earnings over the next 6 to 12 months and pricing that into stocks right now. It's why you can get higher stock prices in the middle of a global pandemic, even when the economy is falling to pieces. The stock market looks beyond that current problems into possible scenarios. So your job as an investor is to think about these 9 possible events, each scenario, each of which is not yet priced into the market because it's so unexpected. Think about how to invest in stocks if each were to happen. Where is the market wrong, and where are you going to be making as much money as possible? To start off, let's look at what the stock market is currently pricing in for 2021. What do investors think will happen? Now, analysts polled by FactSet Research expect earnings to jump 22% in 2021. That blue shaded bar on the right here, if that happens, it would be the highest since 2010 on sales growth of just 7.9% expected. So the market expects those earnings to come roaring back and to justify these higher stock prices of today. Now on a stock sector level, stocks in the industrials and consumer discretionary are expected to be the big winners next year, with earnings growth of 78% and 59% in the 2021. Stocks in the energy sector are also expected to post a big earnings boost, but earnings were negative last year, so the growth rate can't be calculated in this chart. Now what's even more interesting to me though is that the stocks in the tech sector and the communication services are expected to post earnings growth between 13.7% to 14.5%, which is way below the average 22% growth for the total market. Now, why this could be a problem is that tech and the communication sector is now 38% of the S&P 500 index. Almost half of the market is just in those 2 sectors. So what I'm thinking here, what happens if these 2 sectors lag the market, really don't see that big earnings growth, and these stocks underperform? It makes it very difficult for the broader market, that S&P 500 index, to head higher if these 2 stocks aren't rocketing like they did last year. Overall, analysts are expecting the S&P 500 to rise 8.5% in 2021, expecting about 4,040 on the index. Now, stocks in the index are expected to report a combined $169 in per share earnings. That would mean the market is trading for 23.8 times on that price to earnings basis, the highest it's been since 2000, and 28% above the 10-year average. So clearly, right now, the market is pricing in a very optimistic outlook for 2021. And that's where these 9 what-if scenarios come in. What happens to the stock market if each happens? How likely are they to happen? And what should you be doing right now to invest in stocks? So jump in your time machine and let's look at the 9 what-if market scenarios for 2021. One of the least likely scenarios, but also one of the worst, would be a new strain of the coronavirus. that sets us back to zero on the vaccine. Health workers in the UK discovered a new strain of COVID-19 early last December that passes more easily between people and accounted for 60% of the new infections around London. In response, the UK restricted holiday travel and the EU cut flights from the country. The move caused the price of oil to plunge 4% and pressured the market for days. Now, researchers at the WHO estimate the new strain has the potential to be 36% more transmissible than the more common form of coronavirus that we know, though it doesn't appear to be more deadly. Now, new strains of a virus are nothing new. Some viruses mutate frequently. It's why you have to get a new flu vaccine each and every year to protect against that new strain, while you only need one measles shot in your life. So this new strain isn't too much to worry about just yet, but the possibility that the COVID virus to mutate into something that doesn't respond to the current vaccine is way more likely. If that were to happen, expect a big sell-off in the markets, with those tech stocks that have been doing so well lately, like Fastly, ticker FSLY, Square, and DocuSign to boom higher. Our next scenario here, a social media platform is forced to break up. And though we're still into those long shot events here in the list, this one is more likely to happen over the next couple of years. The Department of Justice and states' attorneys generals have filed antitrust suits against Facebook and Google recently, with this pretty much the only thing that the Democrats and Republicans see eye to eye on. The government is arguing that Facebook's acquisition of Instagram and WhatsApp gives it monopoly-like powers on social content and should be forced to sell them off. In that case against Google, it's the combination of Google's search, YouTube, and its cloud business that gives it an unfair competitive advantage in online advertising. But you know how fast the government moves on things, like a snail's pace, so this probably takes years rather than happen in 2021. When it does happen though, and I do believe it's a matter of when, not if, there is a case to be made that investors could see higher returns on the separate companies from these tech giants. When the 7 baby bells were split off from AT&T in 1985, investors booked an average 498% return over the following decade. That's an annualized 19% return and almost twice the market return of 10% a year over that period. Analyst research has estimated that the value of both Facebook and Google could be higher if they were to separate into their segments. For example, just the Google Search, YouTube, and the Google Cloud alone are estimated to be worth at least the current market cap of the company. Then you add in more than $130 billion in cash and the Google other businesses that include Google Play and branded hardware. Revenue from these other businesses accounted for $14 billion in 2019 revenue, and at the current price-to-sales ratio would add another $100 billion in market cap. So all told, the sum of the parts of the company is about 17% higher than the current share price. So here, I think you take any sell-off on the shares, especially if it's related to those antitrust suits, and use that as a buy-in opportunity. This is all news that we're following every day on the Daily Bowtie, so make sure you look for that link below and sign up. It's totally free, and you'll get daily market updates on all the news, trends, and strategies I'm using. A rebound in the value of the US dollar is our third what-if strategy here. And this one definitely isn't priced into the market because the thinking is that the greenback is actually going to go the other way in 2021. In fact, analysts at Citibank think the dollar could fall another 20% this year, and that's after it's already dropped about 12% from the March peak. Now, the value of the dollar against a basket of other currencies like the euro and the Chinese yuan is approaching the lowest it's been since 2018, and even further before that. Now, the value of the dollar might not seem like it matters quite as much to stocks, but this has very real consequences for the economy and stock market earnings. We'll look at the effect of a weaker dollar in our next scenario, but what if the greenback strengthens instead? Now, this usually happens during economic uncertainty or a market sell-off as global investors rush to that safety of the US dollar, that safe haven asset, and push the price of it up. Since commodities like oil are priced in dollars, it forces those prices lower, which hits stocks of energy companies, and the overall market usually suffers. Now, if that happens in 2021, bonds probably aren't going to be the safety investment they have been in the past. Interest rates are so low right now that bond prices aren't going to go up as much to protect you from that stock market sell-off. Here instead, your best bet is going to be investing in the safe haven stocks and companies with less foreign revenue, like utility companies and telecom carriers. Now, good picks here might be something like a First Energy Corporation, that's ticker FE, or telecom giants like Verizon or AT&T. A more likely scenario, though, is that the dollar continues to weaken and maybe even crash from there. Ray Dalio has been calling for a dollar crash for years, and while I don't think the greenback is going to plunge that much, the downward pressure is definitely there. Between huge US deficits, low interest rates, and a gradual loss of that reserve status, the value of the dollar could easily lose another 5 or 10% this year. Another 10% depreciation in the dollar would take it to levels seen only once in the last 50 years and could cause a massive shift in the economy. Now again, since those commodities are priced in dollars, a cheaper greenback is going to mean higher prices for gold and oil. That, combined with higher prices for anything imported, could bring a huge bump in inflation and higher prices for the American consumer. Besides buying shares of energy stocks and maybe the gold miners here, you could also position in companies that book most of their revenue from outside the United States. You see, as the dollar falls, these sales booked in a foreign currency become more valuable when they're translated back into the dollar. So here we'd be looking at companies like Philip Morris International, ticker PM, or semiconductor companies like Qualcomm or Skyworks Solutions, or others here with more than 87% of their total sales from overseas. This next scenario could actually be a big boost for the market, passage of $1 trillion infrastructure bill. Now this one has long been a promise of campaigns, but just hasn't happened in that hyper-partisan government where neither side wants to give the other side a win. But that doesn't mean it can't happen, and we could be closer than ever. Now, the House did pass a $1.5 trillion infrastructure bill last summer with $500 billion for highways, bridges, and public transit, but it just never got taken up in the Senate. President-elect Biden proposed a similar $2 trillion plan, but we have to see now if McConnell is going to take it up with Republicans. The American Society of Civil Engineers has given the U.S. a D+ in its most recent evaluation, and while the group is biased towards more infrastructure spending, there is definitely a need here. Now, if this happens, look to buy stocks of materials companies and those heavy equipment makers. This would be stocks like Caterpillar, ticker CAT, U.S. Steel, which is ticker X, and Martin Marietta Materials, ticker MLM. That's 5 scenarios that could happen but are not certain. Now for these next 4, we're getting into those scenarios that are very likely to actually happen and that could cause big movements in stocks. First here is retaliation by Iran against Israel or the United States. Now, officials in Iran blamed Israel for that late November drone attack that killed a top nuclear scientist and promised an aggressive response. This is similar to the incident last January when a U.S. drone strike killed one of its top Iranian generals, and the country retaliated against U.S. bases in Iraq. And while I do think Iran is generally going to want to play it cool to re-enter a nuclear deal with the United States, officials there are under extreme pressure to mount some kind of a response. Missile attacks have been used in the past to save face, but not inflict too much casualties, and could be used again, but cyber attacks are increasingly becoming the norm. For this, I highlighted 5 cybersecurity stocks after the incident last year, and they produced an average 163% return over that period, with shares of Zscaler jumping 345%. Now, Zscaler, ticker ZS, and CrowdStrike, ticker CRWD, are getting a little expensive, but could still be good long-term picks. Those legacy cyber providers like Fortinet, ticker FTNT, Palo Alto Networks, ticker PANW, and FireEye, ticker FEYE, are great prices here though. This next one could be what brings the market back to reality in the first quarter, a new wave of retail bankruptcies. Last year brought a wave of retail bankruptcies, with 17 iconic brands filing and more than 9,500 stores closed, but 2021 could be even bigger. You see, most retailers have been holding on for dear life for that fourth quarter, that magical holiday season that traditionally has taken consumer goods companies, retailers, into the black on profits. And even though total retail sales weren't too bad for the holiday season, that 22% increase in online sales just sucked all the life out of that traditional shopping market. Any retailer without a very strong online channel just got a lump of coal for Christmas. Now, with no hope for the next 3 quarters, we could see another wave of bankruptcies by retailers and restaurants. Of course, the upside to all this, though, is that the retailers able to make it through these next 2 quarters are going to have less competition. They'll be able to pick up some of that market share online and in traditional brick and mortar sales. So like we've been doing last year, you want to watch the balance sheet of your companies to make sure that they have that cash survivability. Companies like Target and Walmart have done really well with grocery sales, helping to bring people into the stores. But Kohl's, ticker KSS, and Nordstrom, ticker JWN, may offer higher return potential. Both are down more than 25% last year and should survive that retail apocalypse. Now, Kohl's focus on off-mall locations really helped it in sales when the malls closed down, and Nordstrom went into the pandemic with fewer stores and a healthier balance sheet. We're down to our two biggest market-moving scenarios, and this next one is problems with the vaccine distribution. Nation, we're just getting started on the greatest logistical challenge in the history of the human race. Trying to get 7 billion people vaccinated, and that means 14 billion doses because you need 2 hits of each of these vaccines. It's not something that's going to go off without a hitch, and in fact, we've already seen that last month, the US failed to hit its target by almost 19 million doses. By comparison, the US vaccinated about 175 million people against the flu in 2019, and that was a decade high. Now we're talking doubling that amount against COVID, plus vaccinating against the flu at the same time. So from manufacturing problems to getting those doses distributed to problems with the extra cold storage that they need, something will go wrong, but will it move the market? Now, Pfizer said late last year, that it was going to have to cut its initial vaccine target in half due to supply chain issues, though it still expects to distribute 1 billion doses by the end of 2021. But this is just the beginning, and issues could come up in anything from supply of vials, needles, and distribution. Add in the problem of keeping these vaccines at a negative 100 degrees Fahrenheit, and there's going to be bumps. Now, the cut to Pfizer's target didn't spook the market too much last year, but a slower than expected rollout could be a hurdle for stocks in 2021. I would position here for companies along that process, like CVS, which we have as part of our 2021 Bowtie Nation portfolio, and FedEx, ticker FDX, which should benefit all year on that distribution. And the scenario here most likely to play out, a good economy, but weaker market returns. And Nation, wouldn't this be an ironic twist to what we saw last year when the economy was a complete dumpster fire, but the stock market soared higher? The outlook here really comes from 2 factors. First is, again, the idea that the market is forward pricing. So it's already priced in a lot in the stocks this year, that rebound in the economy. Investors are already expecting a 22% earnings growth, and it's unlikely that that's going to happen in the next year. So that reversion to the normal growth in earnings, that's going to take some of the enthusiasm out of stocks. Now, the second reason the stock market could underperform the economy this year goes back to the idea that 38% of the market index is in those tech stocks and the communication services. Exactly the kind of stocks that boomed in the lockdown. So as we see life and the economy get back to some version of normal, the stocks in those sectors might not do as well, and that's going to hold back the returns on that broader market index like the S&P 500. Now, what you can do for this, consider the ETFs outside the index. So maybe funds targeting specific sectors that should do well, like healthcare and financials, rather than investing in the market index, that SPY fund, the S&P 500, or in the tech sector. Click on the video to the right for the top 5 penny stocks I'm buying for 2021. 5 stocks that could do multiples on your money. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.